Hello everyone, this is Jordan. Welcome back to the Daily Gold YouTube channel. Thank you so much for tuning in. This video is being recorded on Sunday evening, December 22nd, 2024. Hope you all had a great weekend. And in this edition of Macro Mondays, going to talk a little macro with respect to the economy. So some comments on the economy with respect to maybe a bit of economic data, but also more importantly, how markets are reacting and acting. So let's get into it and see how it will impact gold in 2025. So first off here, these are just four charts of macro data, macro indicators. I'll try and go through them relatively quickly. This is the probability of a recession in the US based on the yield curve and other bond market data. You could read all that here. So this is a Fed indicator. Now it has come down. As of November, I believe this was about 35%. A couple of months before that, it was much higher. I mean, it was earlier this year, it was well over 50%. So it's still at 35% or so. It has come down. But if you look historically, just because it comes down, that doesn't mean it can't pop right back up. I mean, there's examples of that. You can see here in the late 60s, I believe this was 66, and then 68, 69 started rising again. Another example was, we could say in the late 80s, this was probably 1987, so that comes back down, then moves right back up. This is a better example, early 2000s, where this was, looks like this was probably 98. Yeah, this was 98, so that went down. It goes back up end of 99 into 2000 at about 30%, then comes back down, but then shoots back up again. So it's very possible here that we could, see this turn around and go back up like that. And, maybe quicker than people think. And just, again, do a couple more charts here. So this is capacity utilization. And so we can see when this comes down, usually a recession happens. I mean, we can see it peaks before a recession. I mean, there was a big lag at these points. So that's possible. It did come down here, but didn't cause a recession. Obviously, it peaked here. Then you had the COVID crash. So this has come down for looking at for a few years. So if this keeps falling, I'd probably think down below 75%. I mean, that has to be a big warning of a recession. So this is at a concerning point. The unemployment rate, that has started to rise, but this is also concerning. The employment to population ratio, and we can see how the last several recessions, this peaks and it rolls over and turns down before the recession. So we can see that happened here. Of course, COVID, the COVID crash, different than the other cycle. So every cycle is different. I mean, there are some similarities, but every economic cycle is different. But look where we are now. This baby has rolled over, and I mean, this is concerning. If this thing really accelerates to the downside in the next couple months, that's going to be concerning. And so now, with respect to the Fed funds rate, we are basically down to the market is only projecting basically one rate cut over the next 12 months. So the market is saying the Fed is basically done. Like there could be one more cut in the next year, but the Fed is basically done with their cuts. And when you look at the economic data, I mean, these are just a couple things here, but again, the unemployment rate is starting to rise. And the chance of a recession is still, well above zero, even though it's coming down. So it just seems we could be at a tenuous point. There's a lot of things going on in the world, and there's not a lot of room, not a lot of room for the economy to avoid a recession at this point. And I would say this is something to keep in mind for gold. So gold's getting hit because the market has removed a lot of the easing or most of the easing to where there's only one cut priced in. So gold is set up to do really well if the Fed has to re-engage in easing and do it aggressive. The more aggressive the Fed has to be in future easing, obviously the better it is for gold. And the issue with the stock market and the economy, and this is where I think their precious metals could diverge, is obviously if the economy rolls over and looks like a recession is imminent, the Fed's going to have to cut aggressively. But that's bad. I mean, the stock market, we know when the Fed has to cut aggressively at this point, at this context, it's actually bad for the stock market. Eventually, when the Fed gets done cutting and there's a little lag time, then the market can make a bottom. But so that's one thing to consider with the Fed, gold, and rate cuts. But let me get to other indicators that are more my speed, talking about charts. So here we have the Fed funds rate, the yield curve, gold against the stock market, the real 10-year yield, the S&P 500. These vertical lines are when the Fed starts cutting. A couple things here. The real 10-year yield. So this is the best indicator for gold. When this is declining, that's really good for gold. Obviously, when it's rising, that's not good. So this, because the 10-year yield has started or has rebounded, significantly recently. And in inflation expectations long term are still relatively high, but shorter term have come down a lot. So because of that, real interest rates have moved up in the last few months. We can see here, 155 to 227. So that's hurt gold. This is the best fundamental indicator for gold. Now, gold against the stock market. Let me bring in the yield curve here, because the yield curve, we talked about this in past videos. When you get this steepening where the curve goes from below zero, it uninverts or deinverts, and it steepens. It's rising really aggressively. That's recessionary. That's bullish for gold. When it does this meandering shit, that is not bullish for gold. Meandering here, not bullish for gold. But steepening, you get that kind of a rise, that's bullish for gold. So we can see if we look at these last couple, steepening here, bullish for, although it was temporary, that was bullish for gold against the S&P, I should say. It's bullish for gold against the S&P. But we can see here, big time steepening, gold against the S&P really starts moving up. Same thing happened here. Of course, back here, we are in a different, secular cycle. We're in a big secular downtrend. But it's important to, know that history. And so the yield curve, we can see here, this has steepened in the last few months. It's broken above zero. This is the 10-year yield minus the 2-year yield. Now it did a back test of zero. Now it's moving up. So this is a question. Like, if the economy is really going to fall into recession in the next 3, 6, or 9 months, this thing, if we start seeing it surging higher and really steepening, what that means is the 2-year yield, which you'll see in the next chart, that means that the 2-year yield is probably coming down and the market is discounting the Fed having to hike a lot more than it's discounting right now. Remember, it's only discounting one cut now. So you get a big surge like that, that's the market discounting the Fed having to ease a lot more. And as I just showed you before, we see that could get gold against the S&P breaking out. And if you follow my work and my videos and my art, you know that, this is a huge key here. This is the holy grail. This starts a new secular bull market. So the market discounting a lot more cuts, yield curve steepens at the same time, and in turn, this baby will break out. And then this, because if the Fed, or the market rather, when the market starts to sniff a lot more rate cuts coming, that probably aligns with a recession, then you're going to see this baby roll over and go back down again. Now, let me get to the last chart. This will be a little bit more shorter term oriented, and I apologize that I couldn't make this chart wider, because when I do that, then there's too many things here. When I make it wide across the entire page, but you can't even see the trends. Like, there's just a bunch of lines that look like they're going sideways. But anyway, so we have the 2-year yield here, the 10-year yield curve, stock market, gold against the S&P, the dollar, gold against foreign currencies, and gold. So I'll try and run through most of these quickly. So let's talk about the 2-year yield and the 10-year yield. So notice the 10-year yield has been trending higher. Now, the yellow here shows when the 10-year yield was rising aggressively, that was bad for the S&P. Bad for the S&P. So this move here, it's rising aggressively again, and the S&P down here, it's actually trending up. So there is some money that is selling bonds, selling long-term bonds, and going into the stock market. The dollar is also going up, so it's dollar milkshake theory. Maybe that's playing out. But that's really interesting. So that's different than what happened previously. But at the same time, 4.52% for the 10-year yield. If this baby keeps rising and gets up to 5%, even above 5%, we know from history that's really bad. Like the market and the economy can't handle that. So eventually, if this keeps going up, that's going to top and roll over at some point. And the 2-year yield, yes, this has rebounded, but it's not going up as fast as the 10-year yield. And that's why the curve right now is steepening. And so let's get down to the dollar. So this looks better on a weekly chart. You had this big move up here, this long sideways, you call it a saucer bot. This looks better. Again, this looks better on a weekly candle chart. So this is broken out 107. So this should probably run to 114. Maybe it even goes to 120. So the dollar is definitely trending up, has room to move higher technically. Gold against foreign currencies. So I believe it was Martin who made the comment on the last video that this is really just a dollar move in gold. Like it's just dollar strength. And this is gold against an ETF, which is the dollar basket. So you can look at gold against foreign currencies that way. So this is, for those who don't know, this is looking at the gold price and basically eliminating a weak dollar. Another way to look at this is gold multiplied by the dollar. And so look at this. This is barely, I looked at it. This is only 2 or 3% off the high. Whereas gold nominal in nominal terms or regular dollars is more than 2 or 3% off the high. So a lot of this weakness is dollar driven. And so going back to what we said in the last video, you get the yield curve making a big move like that. That's most likely to happen again because the economy is slowing towards recession, and the 2-year yield in that scenario probably rolls over. It rolls over like that. And eventually the 10-year yield will roll over when we do have a recession. But again, if the yield curve makes a big move like that, you're going to see the 2-year yield roll over first and really come down and accelerate to the downside. And again, eventually the 10-year yield will follow. But that's how you get the steepening, is the short end plunges a lot more and faster than the long end. And when that happens, then you get gold against the S&P probably breaking above 0.50. But in the short term to potentially medium term, does this thing trade lower like this? Can it hold these lower highs? We'll see. But that's a possibility. But I do want to note, eventually, if the dollar makes it up to 115, 120, eventually that's going to be negative, which in turn is positive for gold. Let's go back a couple of years. Keep in mind this move in the dollar. Look at this move in the dollar. Well, gold against the S&P bottomed here in the middle of this move. So if the dollar, again, runs all the way to 115 or 120, that doesn't mean gold bottoms when it hits 120. Gold will probably bottom. The correction will end before. So there's many different things here to watch, but staying with the dollar, because this is a big factor right now, and also the 10-year yield, the more this rises and the more the 10-year yield rises, eventually those are going to be negative for the market and the economy. And while those things are rising at the same time, we have to watch the yield curve. Because once this starts going like that, that is a real bullish catalyst for precious metals. So up to 15 minutes, long video. Thank you so much if you made it to the end. So long story short, to give a Cliff Notes, actually this is like the Cliff Notes to the Cliff Notes version, to give that summary, we are in a scenario where it comes down to precious metals and gold. They need a recession. They need a recession next year. The economy's weakening. Maybe we get a soft landing. That would be bad for gold. The Fed being able to pause for a long time, 6 months, 9 months, that would be bad for gold. What would be good for gold? The economy slows. The economy goes into a recession. That's bad for the stock market. Money will move out of stocks. The Fed will have to cut aggressively, and they have lots of room to cut. That's really good for precious metals. So I think at some point next year, we are going to see that where the economy slows down, falls into a recession, the Fed will have to reaccelerate its easing. And in that scenario, that's going to be very bullish for precious metals. And we'll finally see gold break out against the 60-40 portfolio, and a new secular bull market will be confirmed. No, I don't think it's going to happen in the first quarter, but I do think it's happening sometime this coming year. So again, thank you so much if you made it all the way to the end. And leave a comment. Let me know what you think. Would love to hear from you. I'll talk to you guys again in the next video.